Governor Martinez. Peter Frank.
Here.
Secretary Rodriguez. Here. Linda Eisen.
Here.
Tim Jennings. I'm hoping I'm gonna connect him in on the phone. Harold Lavender.
Here.
Treasurer Eisenberg. Commissioner Dunn. Lee Rawson.
Present.
Scott Smart.
Here.
And Lynn Hobson.
Present.
Okay.
We have a quorum.
Okay. Approval of the agenda. I would like to suggest that we move the item on 6 up to the front of the agenda. The governor will join us by phone, and she would like to participate. So I'll move it up. If everybody approves, we'll move it up, and we'll pick it up as soon as she joins us. So we'll move on with the agenda until she joins us. So, everybody's, thank you. All in favor?
Aye.
Thank you. Appreciate it. Minutes of the prior meeting. Any comments or corrections?
Motion to adjourn.
Thank you. Second. Thank you. Second. All in favor?
Aye.
Thank you. So let's go to investment items. Paul, can you lead us to the report? At this point, assume we all read it.
We did not have a quorum, we only had 2 quorum members, so our recommendation for the investment before the committee is an informal recommendation. We did not approve of it. Otherwise I will presume people have read it. There's some things that would be fruitful to discuss, but I think that maybe
Your entry,
consideration of the hour.
is not valid. Please enter the
Okay,
correct.
very good. So the next item on the agenda is Blackstone. Good. Thank you.
Well, good morning, everybody. We're here to, first of all, introduce, everybody knows Jack Koch and Seth Marcus from Townsend. They'll be giving the Townsend view on Blackstone Real Estate Partners 9. We've also got Alex Hill with us and Tyler Hendrickson from Blackstone. Tyler's head of acquisitions for Blackstone and acquisitions as the senior managing director. Staff in Townsend recommend $100 million to Blackstone Real Estate Partners 9. A global opportunistic closed-end fund seeking to raise approximately $3 billion. I'd like to overshoot that number. The fund will target gross returns of 20%, 14.6% net, using 65 to 70% leverage by executing the following strategies: portfolio acquisitions, platform acquisitions, including take privates, single asset purchases, that will be very large ones, discounted loan purchases. In all cases, Blackstone seeks to exploit distress, under management, and complexity. One of the interesting things about the way Blackstone structures this series of funds is that no more than 40% of the fund will be invested alongside their Europe and Asia funds. So that'll go into invest alongside BREP Europe 5 and BREP Asia 2. So it totally gives,
Enter your access code.
it gives us good global exposure through this one fund. Relative to investment pacing, the proposed $100 million commitment to BREP 9 will take us slightly over by $19 million, the 2019 Townsend pacing rate of $243 million a year.
Please enter your tier three.
Within the real estate portfolio, Mexico has the following existing Blackstone commitments. We have BREP 7, we've got Blackstone Real Estate Partners Asia, we've got Blackstone Real Estate Partners 8, and with this investment in Fund 9, that will be a total of $300 million in commitments, and about $150 million in market value. We like this offering because Blackstone's real estate funds have been very, very strong performers. Jack and Seth, or Jack will talk about that a little bit when he gets up. Blackstone attracts the best and brightest minds in the real estate industry and supports them with unparalleled resources and market access. Because of the large size of the fund, Blackstone will really be highly differentiated competitors in terms of being able to take on very, very large deals that have a very small number of investors that can truly pursue them. And this will also help build out our non-core portfolio, portion of our portfolio We're targeted 55% core, 45% non-core. We're currently about 60% core, 40% non-core. So with that, turn it over to Jack.
Great. Okay. Thanks, Paul. Good morning, everyone. As Paul mentioned earlier this morning, to discuss a $100 million commitment to Blackstone Real Estate Partners Fund 9. As mentioned, this is a follow-on commitment. The entire exposure through your Blackstone commitment. So Paul mentioned the real estate exposures that you do have to Funds 7 and 8. You also have exposure to Blackstone Real Estate Asia, in addition to a few energy investments, as well as a recent investment to the infrastructure fund. If you combine all of those commitments, you're at roughly $450 million in commitments. However, only about $180 million of actual market value exposure today. So that represents less than 1% of your overall SIC plan assets, and about 2% of your overall real assets within the real asset portfolio. Paul did mention pacing for 2018 called for about $235 million of non-core tactical commitments in order to maintain exposure in line with your risk return profile. That capital has been fully committed due to prior investments that you committed to throughout 2018. So we are looking at this as a 2019 commitment. That said, there is very little expectation, given that Fund 8 is still being invested today, that any of this would be drawn this year, within the last month here. And furthermore, probably not until second quarter of 2019. So actually it falls very well within the pacing for your 2019 commitments. If we don't commit to this today, this opportunity will not be an opportunity for the SIC. They do anticipate reaching their targeted fundraise here, about $20 billion within the next couple of weeks. So the investment needs to be closed prior to year end. This is a continuation of Blackstone's historical targeted strategy, really acquiring high quality assets through large, complicated transactions where competition is typically limited, and Blackstone has the ability to move quickly and with scale to bring those assets through execution. In its simplest form, and many of you have probably heard this through previous Blackstone presenters as well as ourselves, the real strategy is buy it, fix it, and sell it. The fund is targets distress or undermanaged companies, then executes business plans to fix the deficiency, and then ultimately positions those to be sold to core buyers across the globe. Assets will range in size and type. However, they will also they will likely be large-scale transactions that really drive the portfolio and performance of the portfolio. Property types historically have been a bit overweight to office and hotel. That really is due to the cyclical nature and the volatility that we see in those property types. However, and I'm sure that Tyler may focus on here in a couple of minutes, is that a lot of the near-term opportunities and some of the recent opportunities that Blackstone has looked at has been infill logistics as well as Class B multifamily repositioning. Two strategies and property types that Townsend does continue to support, given, if you think back, a number of the commitments that we made year to date have focused in on those strategies as well. Consistent with your other funds, leverage here will be capped at 85%, though there is no individual property type, or excuse me, individual property leverage cap, although leverage historically has been about 65 to 70%. Fund 8 today is tracking at about 66%. As mentioned in your materials, you do find the track record exceedingly attractive, the firm's resources, as well as their culture, and then lastly, the size of this specific fund to be strong competitive advantages. Throughout the cycles, the direct global funds have produced consistent, attractive net returns. This level of consistent outperformance is really among the best in the industry. The detailed performance is included in your materials, and as you can see, has been quite strong, really dating back to the mid-90s within real estate. Blackstone, as an overall firm, was founded in
Hello, this is Donna Martinez. I'm on the line.
Oh, Governor, thank you for joining us.
Of course.
Yeah, let me can we defer for a second? Sure. Because we have limited time. And let's move to agenda item 6A and B that we moved up to the front of the agenda. And bear with us, please, Blackstone. I will turn the session over to Evan to lead us through these two settlements.
All right, and also joining me at the table is Bruce, and I'll just kick it off. To the governor on the phone, good morning. To the rest of the council members here, good morning.
The Governor, can you hear
Can you
okay?
hear me?
Yes, I can.
Great, thank you.
Okay, this is Evan talking. So we have two settlements for you today for your consideration. These are settlements that are not effective unless and until the council votes in the affirmative. We do have a quorum here today, and we would need a majority of that quorum to vote these through. We have taken a process with respect to these settlements that's transparent. It's fully public. We're doing it in open session right now, and the materials are in your meeting book under diligent, as well as in a PDF copy if you have those. I will say at the outset, and this is going to be a quick 2-minute speech, that this is a settlement of disputed claims, and I should say fully disputed claims, vigorously disputed claims, as well as the settlements have non-disparagement components to them. The idea being that if someone pays us a lot of money and or cooperates and pays some money, they should have some peace of mind and not be disparaged. And I want to highlight those contractual provisions for folks in the room. I would also point out that these settlements are of either a tangential case or tangential defendants. Our main case, our main alleged pay-to-play case, remains set for trial next year, pending in Santa Fe, and this doesn't end that case in any way, shape, or form. These two settlements are notable in that they would bring our recoveries, and that's money that's either our gross recoveries, that's either escrowed or in hand, to just under $50 million. And since we're an investment operation and the legal department prosecutes on the side, that's somewhat notable. I think the actual number, if you're keeping a calculator, is 49.16 million by my tally. The first settlement is against an entity, with respect to an entity, I should say, called Shoreline and other related parties. And that would be our second largest in-cash, in-hand monetary recovery to date. It's $5.65 million, non-escrowed money in hand, 30 days from the date should you vote yes. We've litigated this Shoreline case for years, pretty zealously. Motions to dismiss have been filed, multiple mediations. We started making demands, and I'm trying to be very factual. This is all public record. Back in June, that we're just trying to resolve. Our mediations, plural, the first of which didn't work, was before an independent third party. Obviously, the defendants fully contest the claims, and in part are offering what we view as a very favorable number for certainty and ending the case. And part of the condition was that they asked us to bring it today to your attention, because this has been going on for the better part of 2 years. A little bit about why this is a big number in my mind. The 5.6 million is far in excess of what we believe was paid in placement fees related to this investment. I'll say far in excess. We believe that number is very close to the total management fees paid with respect to this investment, with respect to Shoreline and related parties. And this was a 2005 investment. We redeemed out, we transferred it to another holding platform in 2008. So there's been sort of a 10-year gap. This is another world. And so some of these numbers we would have had to really flush out in discovery, because we're talking 10-year-old numbers. People could test what they were. The final thing I'd say is defendants contend they made money on this investment. And so I think that's,
I'm sorry, say it again.
the defendants contend they made money on this investment. And so
They made money for us?
for us. So at the time we liquidated or redeemed out, transferred it in 2008, the defendant's position, and obviously we haven't fully litigated the case, was that we were up about 8.5 million. The second settlement is an individual defendant, Barrett Wisman. It's related in many ways. We have made him pay some money of his personal funds. It's $15,000. But the key element of that is cooperation in our mind. It's in the settlement, it says cooperation.
And it's our view that he contributed, and I'm not going to say more because it's privileged, with respect to the shoreline settlement, which is why they're together. I will say that we have done asset searches with regard to Wissman, and as staff is comfortable with the number, I should say our outside counsel has done asset searches to professional companies. And Mr. Wissman is no longer in business as an investment type business. We've also held up that settlement for a couple of years. We had an agreement in principle, but we were waiting for the cooperation, and that's why they're tied. That's all publicly available information. You have publicly available information in your book, and that's hopefully sufficient, but we will endeavor to answer questions should you have them, but we will respectfully defer on privileged matters if that is the case, keeping in mind the large settlement with Shoreline, the disputed nature of the claims, and the non-disparagement clause, so I'm going to be very careful.
Very good. All right. Council, any questions? We've had these before. There's a 7th, 8th, 9th settlement as we work our way through this process. And I think we're in a position to move forward on it. Anybody have any questions? Okay, then, yes, Linda. Okay, please.
I move that the council approve the settlement with Shoreline Inc. and related parties as set forth in the public meeting materials and as discussed by the council today.
Second. All in favor? Aye. Any opposed? Very good, thank you. And the Wissman settlement?
I'll proceed with that. I move that the council approve the settlement with Barrett Wissman as set forth in the public meeting materials and as discussed by the council today.
Second. Okay, again, any comments? Ready for the vote? All in favor?
Aye.
No opposed? Tim Eichenberg should be marked as opposed. Governor, we didn't hear your vote, but
Yes, aye.
Governor, your eye on both?
Aye on the vote, yes.
great, thank you very much. Okay, I think we're concluded with that matter. And hopefully you can hang on, Governor, as we go through some of the Black Rock and return to that report. Okay. Blackstone, I'm sorry.
I wasn't gonna correct you.
Travis and I have Black Rock. We have a very close history of two partners.
Once one.
Okay, so continuing with our story on the $100 million commitment to the Blackstone Real Estate Partners Fund 9.
Sure, I will try to wrap up my comments here. I was just touching base on the firm's resources and culture. The Blackstone was formed back in 1985 as an alternative investment manager. Since that time, they've grown to become one of the largest alternative investment firms around the globe today with approximately $440 billion of AUM. Real estate being a critical piece of that today accounts for over 30% of their top line revenues and has approximately $120 billion of that AUM. So real estate is a critical piece of the overall business. The last point that I would make is the culture and the brand of Blackstone is significant. It's somewhat of an intangible. Individuals want to be employed by Blackstone, and on the other side, individuals want to do business with Blackstone. And that is due to their speed of execution, their surety of execution, they're quick with a response, either yes and no, and things of that nature. So I think that is an intangible. It's hard to quantify exactly, but you know that it is there, and it's something that certainly provides them a competitive advantage. Alex and I were talking before that they have roughly 11,000 applicants for a very, very small number of new analysts that they bring on an annual basis. So,
Analysts by 100 people, we got 11 now.
so I think that goes to show the strength of much of the brand. So with that, there are always issues and concerns outlined in the document. Happy to take any questions on those. Given the essence of time in the public setting, maybe I'll pass it over for this time to Alex and Tyler to walk through their prepared remarks and we can go over some questions. Great.
Well, thank you, Jack. Thank you, Paul. I feel as though you guys did such a thorough overview of our fund that there's not as much left for us to say. And I'm Alex Hill. I run capital raising for Blackstone Real Estate here in the Americas, and I'm joined by Tyler and Ritzy, who runs acquisitions for us for this fund. We're here to talk about Prep 9, which, as both Jack and Paul mentioned, is going to be a $20 million fund. We've had a lot of success and good fortune in capital raising, so we expect that we'll hold one closing in the coming weeks, and we're grateful for that. What I would recommend is that I turn it over to Tyler to talk a bit about the fund and the strategy, but please interrupt us. Anything that we can do, we're truly here to be useful to you, so please.
Thank you, Alex, and thank you for the introduction. I'll try to be fairly brief here. I think at the end of the day, from our standpoint, it all comes down to returns. We feel a real sense of responsibility that when you or other investors entrust us with your capital, that we're judicious with how we invest it. And so I know our returns were mentioned, and you got the materials. But when we think about our track record over 27 years, we're very proud of the fact that we've been able to deliver over that entire period of time 16% average annualized net returns over that entire period. Obviously, you had windows of real dislocation in the market, and I think that's when our business in particular thrived and outperformed. And we know that from our standpoint, the only reason we have the opportunity to sit here today and present to you guys in the plan is those returns. And so we take that very seriously, and we're proud not just of the absolute levels, but the fact that we've been very consistent through up and down cycles over basically a quarter of a century. And that, in a lot of ways, has resulted in what our business is today. And today, I think our scale was mentioned. That really is our differentiator. It's not just that we're able to focus on larger real estate transactions that are less competitive because of the size of the deals. It's also a function of the fact that given our extensive holdings, not just in the US, but around the world, we get an incredible amount of data that comes off of our large office holdings, our industrial holdings, our multifamily holdings, and we really are making investment decisions based on the information that's coming off of those owned assets. So yes, we read research reports, we have incredible access to resources, broadly speaking, but the data and information that we get off of our holdings really gives us a real-time sense into where fundamentals are strongest and where we should be focused on investing. And I think in a lot of ways, our returns have allowed us to grow and scale, and now our scale really allows us to perpetuate those returns. When we look at the world today, our strategy for our 9th opportunity fund is very consistent with what we've done in the prior 8 funds. And it's really, as was said, focusing on larger, complex situations where we're able to take advantage of our deep bench of resources, both in-house at Blackstone and externally in the field that we do business with. In the materials on page 5 is a handful of transactions that were BREP 8 investments that are all multi-billion-dollar transactions, many of which we were the only group bidding on, or one of just a couple. When you talk about a $9 billion public company like Biomed, there just are only 1 or 2 groups that can actually effectuate those transactions that oftentimes results in better pricing and better returns over the long period of time. Not only do we focus intensely on making sure we're focused on the right geographies and the right sectors to invest in, we also have a very extensive in-house team that helps us manage and create value once we own real estate assets, and we're proud of that as well. When we think about the themes or strategies today that in this environment we find particularly interesting, I'm just going to hit on a few real quickly. One, logistics. With what's happening around e-commerce and the change in terms of how goods move through the supply chain, the demand for industrial and distribution space is booming, and in particular in very dense infill population centers. That's been a big focus for us. I think it will be a big focus going forward. Rental housing. Coming out of the financial downturn, the country as a whole is really not building enough sort of workforce housing, affordable housing in a lot of major population centers. That's an area of focus for us, in particular where we're able to come in and invest capital, improve those properties, and create a better housing opportunity for our tenants. Third strategy, we have a term called innovation cities. And these are cities that are really attracting the best and brightest coming out of the top universities around the country and around the world, in cities that are attracting sort of technology-oriented talent. And we're focused on office investments in those markets, office buildings that really cater towards a technology and innovation-oriented economy. And then finally, we're focused recently on some very large resort-type assets in locations that are very difficult to build in, so difficult to kind of replicate assets in. Hawaii, in particular, would be an example. We've bought several very large-scale assets on the beach in places like Maui and Honolulu where it's very difficult to get approvals to build new hotels, but because of things like inbound Asian travel and a propensity today for people to spend a greater percentage of their disposable income on travel as opposed to material goods, we're seeing sort of an opportunity to focus on those assets. So I don't want to be too long-winded here. Would really just summarize that, again, it all comes down at the end of the day to the returns that we've been able to deliver over a long period of time. And if we stop being able to do that, I doubt we'll be welcomed back here. So we appreciate the opportunity to present today. And I guess I pause there and open it up. I'm happy to answer any questions you guys may have.
Okay. Do we have questions? Yes, Linda.
Yes, based on the recommendations,
I just wanted to be sure we don't have any questions yet. Give me a couple seconds.
I think what I'd like to just say is that, again, the investment committee, we couldn't make an actual recommendation, but there were just two of us. But Linda and I both agreed that we like this investment a whole bunch, took a good look at it. I asked Jack, and I think you guys are on the phone, about the leverage. The one thing about it is that they do have an 85% potential to leverage. And I think that, based on what happened back in 2008 and everything else, I think that's always a legitimate thing to look at. But I think their leverage, if I understand correctly, you've kept the leverage pretty well industry standard industry. But I realize you guys are so big that it's a little bit tough you don't have a lot of peers. But it sounds to me like you
I
kept
can
it in
comment
those
on
ranges.
why we have the 85% cap, which is definitively a high number. We've been doing this for 27 years, and before the financial crisis, we didn't actually have a cap on our leverage. So coming out of the crisis, as we started to do this again, raising our Prep 7 fund, investors said, gosh, Blackstone, what we need in order for our boards to approve this is you need a cap. And so we picked the 85 number, which was far out of where we ever expected to be, just to give us a lot of flexibility. I think because we've had so much success being responsible with leverage over a long period of time, our investors will call about that. But it's actually exactly what Jack said. We historically, for the past quarter century, run it in the high 60s, and we have no expectation that we will ever get it. We've never come close to 85, and it's really because we love flexibility more than anything else.
And high 60s to 70s is very typical for an opportunist.
Thanks.
Okay, any other questions? I have one, a little bit personal, I suppose. I'm just struck by, on page 6, the Cosmo deal. I wonder if there's any quick story on Cosmo.
Oh, we could make it quick or long.
Sure. I'll try to be quick. I personally led our investment in the Cosmopolitan. It was a project that was coming out of the ground by a developer during the downturn. There had been a plan to sell off condos.
Right.
A lot of the condo buyers had walked from their deposits, and a large global bank, had taken over the project and had a tough decision as to whether or not they wanted to walk away from it or finish it. They decided to finish it. They ended up spending a lot more money than they thought. They spent $4.3 billion to complete what at the time was the nicest, newest casino right on the 50-yard line of the Las Vegas Strip. 3,000 hotel rooms, lots of restaurants, retail, etc. They opened it at the worst possible time. As a bank, their area of expertise was not managing large-scale hospitality assets or casinos, and they struggled. And we ultimately had the opportunity in 2014 to step in and buy a property. We bought it for $1.7 billion.
100%.
100%, or 100% of the asset for $1.7 billion. It was built for $4.3 billion. When we bought it, the asset was doing about $100 million in EBITDA. So some people looked at us and said, well, that's a pretty healthy multiple, 17 times earnings. We looked at it a little differently and said, that's one way to look at it. Another way to look at it is 57% discount to what it was built for. We knew from an operational standpoint, there was a lot we could do to improve operations. We brought in a new CEO. We invested a couple $100 million to fix some of the flaws, including finishing the top 4 floors. And the asset this year did $300 million in EBITDA. And I think it's quickly approaching, from a value standpoint, what it was originally built for. And so I think a great example of, again, a large scale opportunity where we're able to buy at a discount, come in with our operational expertise, and generate a very healthy outsized return for our
What do
investors.
you think the equity multiple on that is today?
I think we'll probably ultimately, by the time we sell it, which I think we're beginning to think about, it could be a 4 or 5 times multiple on our original invested equity.
And that, of course, is in the fund that you guys are in.
Yes, I know.
It's
One reason why I was interested.
I wish they were all that good.
I was just there, and it's unbelievable. Most massive close I've ever seen.
Thank you for your business.
I'm not so sure you. I'm good that way. Okay, we're ready for it.
Based on the recommendations of the Council Investment Committee, Real Estate and Real Return Advisor Townsend, SIC staff, and the General Fiduciary Oversight of Laura BK, I move that the State Investment Council approve up to a $100 million commitment to Blackstone Real Estate Partners 9 LP, subject to and contingent upon New Mexico legal requirements, Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Okay, any other discussion or comments? On the assumption we get another Cosmo, I think that's. All in favor?
Aye.
Anybody opposed? Very good. Thank you so much.
Thank you all.
Support, we're grateful.
Next item on the agenda is monthly reporting. Standard monthly reporting.
That's right. Thank you, Mr. Chairman.
This is actually our quarterly.
Let's go ahead and hit your September quarter.
Right. Okay.
Well, we've had a rough ride in the equity markets the last couple of months.
Was there a
You
change?
haven't noticed, that's right.
Something I missed?
But stocks are down 8.5% from their August peaks. More than half the stocks, this was kind of interesting statistic, more than half the stocks are down more than 20%. More than half the stocks are in their own bear market out there. That's half the stocks in the S&P 500. So lots of stocks are down. There's a few that hold in there better. That's their larger investment holding the overall market. Tech stocks, which have been leading, have really rolled over. They're down about 14.5%. Look at the NASDAQ numbers. More than 50% of their stocks are down more than 20% also. So lots of sell-off going on here, at least in the stock market. The response from the bond market has been quite muted. We predicted that, but we didn't predict it quite this muted. So stocks are down 8.5, small stocks are down 14.5, and the bond market moves 15 basis points. That was really odd. Not so odd, it was more muted than we expected. The bond market. Normally you get bond market coming down, and same with particularly funds that do the 730, they really like when the bond yields come down, give some profit in our portfolio. That didn't happen. All they got was the loss on their stock. Also, credit spreads hung in there pretty good. So I follow a credit spread index that is off only 2%. That's not 2 percentage points. That's just 2% off of the index that follows credit spreads. So credit spread is hard to move while stocks have gotten pounded. So what's going on? Well, not much that we haven't already prepared for and talked about in this room for several months. And this is late cycle activity. This is really typical stuff. So the things we've been doing over the last couple of years, recognizing where we were in the economic cycle and moving toward those cash generative investments, moving out of the stock market, trying to stay away from interest rate risk, those things are really starting to pay off. I think next month we'll be able to show you one of the places that she did something specific is in the domestic equity portfolio. We thought that portfolio had about a 0.92 beta to the overall stock market. For October, it had a 0.90. So it's almost where we thought it was when we constructed that particular portfolio. We'll have lots more data for you next for January. We'll have both October and November since we had sell off this one. Let's see. So other things that are going on, a lot of people are saying, why is this happening? Well, Fed funds rates up, interest rates are up since the spring or early in this year. GDP seems to have peaked. Those are some of the things that people are saying has caused stocks to sell off. Yeah, we agree. Those things have some meaning to them. But also we think that this is more of a valuation correction, because one of the things that is corrected most in this market is the PE ratio. So, which is a value metric of the market, it's down 17%. So while stocks are down 8.5, PE of the market is down double that. What's happened is prices come down, and earnings have continued to come up. The denominator is increasing, the numerator is decreasing, down goes the ratio. So I think what we're seeing here is just more or less of a valuation correction than much else. And most of the time, the stock's pretty positive between Thanksgiving and Christmas. So we got the stats on our side that have to be up a little bit here. And this really doesn't look like one that's really gonna fall apart on us, sans some, external thing that's happening. The other two things I wanted to report to you before we move to Matthias and the numbers in your performance report. I just got back from the JP Morgan Global CIO Conference. It's really pretty good. There's more than 80 people show up. Most of those are chief investment officers. This year was a lot of corporate folks and a lot of endowments. In fact, there were only 4 or 5 public people like me at the conference. All total, the assets that were represented in the room are $3 trillion. So it's a lot of people that are making decisions about big dollars show up at this conference. The things that were on their mind was late cycle. Everybody's talking about that now. That we're here and what do we do? Fed activity, credit markets in particular was a discussion topic, of course, the stock market. And in particular, the biggest question was how should we be positioning our portfolios for what's happening and what could happen. In fact, we had a panel on that. In fact, I sat on that panel. And people were really interested in what the panel had to say. There was some disagreement in the room. I had plenty of conversation after that said, this looks like an extended cycle. We're staying pretty aggressive. And, I kind of told them good luck with that. Or, we can't predict those things. All we can do is see where we're at and try to adjust. So it was very interesting, and those were the thoughts that were on other CIOs' minds out there today. The last thing I'll report to you is your peer rankings in the IFX database. Now, this is the one that the LSC uses to rank the 3 investing agencies here in the state, URB, PARA, and us. Your 1-year rank for land grant is in the 17th percentile. Now, I didn't have much expectations of breaking in the top quartile because we don't take one big bet, particularly at this part of the cycle. It does behoove us to take a big bet. It does early in the cycle, but late now, it pays to spread our chips a little bit, and that's what you've done. So we didn't expect to see anything above 25, but here we are at 17. Now there's 60 or 70 funds, between 60 and 70 funds that report to this database. It's a net of fees database. This is after all our fees have been paid. Which means there's maybe 5 boards like you that get to open their performance report and see a bigger number than what Matthias is going to talk about today. So pretty good. 3 years, 39th, 5 years, 36th, 7 years since this council has been in place, 25th percentile. You're in the top quartile over 7 years. And so with that, let me turn over to Matthias unless anybody has a question on things I just said.
Okay, thank you, Vince. So I think these 2 comments. So as you mentioned, we'll see next month your comments on how you think our downside protection strategies actually work through this. But January.
Right. We'll have what's the price star? We'll have Star at the table to talk to you a little bit about how the domestic equity portfolio is responding, because that was one place you did something specific.
Right, exactly.
And then I'll be able to talk more generally about the asset allocation, how that's
Terrific. Yeah, Linda, please.
Sometimes I think that we take for granted the performance figures that we're seeing here. And what is it, Harrison Keeler, who says the town that everybody's above average. And so we expect our performance to always be top performance. And this is an incredibly high standard that we just go, yeah, yet again. So I think that we need to feel extremely not just fortunate, but that we have had excellent guidance to accomplish this. And as we discussed in the investment committee, this has been accomplished understaffed and with a funding that does not permit us to pay and financially reward for this kind of performance. And I guess I was especially struck as I read in the sports page about what other state employees are getting paid for poor performance, like football coaches. And year after year after year, poor performance, and they get rewarded with financial reward commensurate with trying to be in the top category of football coaches. Here we are in the top area of investment services, and we are nowhere near close to paying what would be commensurate with the level of those services. And I think this is an incredible problem, and I don't have an answer for it, but we have many skills around this council. And I think it's something that I would like to ask the members of this council to enlist those skills to maybe try to come up with some answers for fully staffing and more adequately funding. And I also want the council members here to not just go, yes, another great quarter, this is terrific, but to really recognize what a very, very good position we are in with the services that we have had from the State Investment Office and our consultants. This is very remarkable.
Thank you, Linda, for making that comment, and particularly the 7-year, which was a long-term turning of the shift in policy. To see top quartile performance is very gratifying. Should be recognized and commended. Thank you.
Yeah, I second all those comments. I think we're very pleased to have Vince, Paul, and others leading us with Steve's oversight. We've done a remarkable job. Just keep it up.
Now let's look at October.
That's right. Right.
I expected that.
We do have two reports. The first is the third quarter executive summary to provide a little bit more insight as to the performance drivers and the relative results. Vince already alluded, as well as Linda and Peter acknowledged the strong performance, but wanted to take a little bit of a closer look. And maybe I'll turn your attention to page 126. Let's start with the executive summary since that's through 9/30. Then we can take a look at the October performance update that Carrie just passed around to you all. So on page 126, you see the investment policy review. That's essentially a scorecard or to help measure how the program performed relative to the objectives that you set for the program. And you'll notice continued improvement. We've been watching this for quarter after quarter. These numbers here that now say yes for meets return objective used to say no, and they've been yes for quite some time, and that margin has continued to build. We've said that we don't have to design a program that continues to rank in the top quartile quarter after quarter, but one that is consistent and does consistently well. And that is, I think, what you'll see through these numbers. So above 50 basis points on the 3-year for both the land grant and severance tax, positive there. On the next page, you'll see the attribution. This is the other scorecard that we look at to help determine what was driving some of the returns just for the 1 quarter. We typically like to look at it over longer periods, but here we're just looking at the quarter. And you'll see that essentially all of the return in this quarter came from your investment policy strategic asset allocation, so to speak. And you've had some minor plus and minuses across the other categories. On page 129 is the schedule of investable assets. I think one thing there that we've looked at is the net cash flow profile. And here, the severance tax are almost the same. Negative $68 million from a cash flow profile, although obviously very different corpus sizes, and so that's one thing to keep in mind and something that you can keep an eye on. Page 131, here are the ranks. I know this is one page that we like to look at, and certainly testament to the relative and absolute performance of both of these funds. You can see for the peer group greater than 10 billion on the quarter, land grant is in the 35th percentile, on the 1 year, 46, 5 year, 50, and 732nd percentile. So really, with the exception of the 3-year, which is just above the median, you're at or above median there. And then certainly as you move down to the 1 billion peer group, which is really the one I think we look at most closely, there you're above median in some cases. In the top third. So very, very good numbers on a relative basis, and I think it goes without saying that the trailing absolute returns of north of 7 and 9% in some of these trailing periods is very, very high, and I think we're in a position to anticipate lower returns going forward. I think the portfolio certainly is one that is designed to take advantage of that. 132 is the chart that plots the rolling 3-year rank, and this is one where we've continued to see a funnel. That's what we'd like to see and what we've set out to do. That continues to hold true in terms of having ranks that don't fluctuate wildly as they have in the past. You can see that as you move across the left-hand side of that page. Very similar story for severance tax, so I won't go through page 133. You'll see that, but because of some of the more near-term private equity numbers, particularly in-state, some of those numbers look pretty good, at least for those most recent periods. The only other thing I'll say on page 135 of this report, I think this is a nice comparison as you look at the left-hand side of that page. The top left box is land grant for the 5-year period, and then the box below that is for the 10-year period. When you look at the return for land grant, for example, relative to the median, you're capturing 101% of the return, but only 87% of the risk. So you're essentially outperforming with substantially less risk. And that's over the 5-year. When you go back 10 years, it's really an inverse. You're only capturing 94% of that return with 101% of the risk. So really, that portfolio has moved in the right direction over these past 5 to 7 years.
Just one comment if I could, Matthias. We get the question now and then about the amount of risk we take. Usually the question is, are you taking enough? Could we earn more if you took more investment risk? And this fund can take more risk and so forth. It is occasionally comments that we get. So what you're looking at is historic volatility. Now, our expected volatility, where we've built the portfolio, is a little bit above average. And the folks that say that are right. As a sovereign wealth fund, we tend to be able to take more risk. Now, I do have a really interesting chart. Maybe I'll bring it in January when we talk about what works in these types of environments. But it's done by Wilshire, and they have 122 state-level pension plans. And they did a scatter plot similar to this. On the vertical axis is the amount of equity they have in their portfolio, and they just add up publicly traded, private, and I think they add real estate also, versus their funded ratio on the bottom. So what you would expect, right away is that you got this upward sloping thing, right? So the more funded you are, the more equity you would have in your portfolio, and vice versa, right? If you look at the R-squared is 0.002. It's absolutely random. So people don't consider what their funded ratio pension rule. They don't consider what the funded ratio is when they choose a portfolio allocation. So that's one chart I need to show the folks that ask us about our risk. It tends to be immaterial for the pensions, but they are right that our structure allows us a little bit more. We're going to come back this spring with a discussion on that. Sort of where we're at, what we could do, what it would look like if we took more, those kind of things. We're going to break that out in the spring before we get the annual investment.
Then the other document that was passed out, I think this is just a hard copy, is the October preliminary flash report, which provides some very early insight to the returns experience during October. Obviously, substantially more volatility, as Vince already mentioned. Most equity markets were off about 8%. There you can see on the second page, the total fund composite. We don't have the detail for Langer and Severance, but they're going to be very much in line. Down 3.74. I can tell you, looking at some of our other clients, that's better downside protection than what we've seen across the board, and I think it's a reflection of the more diversified nature that you have here. You'll see that for the calendar year today, as of at the bottom, As of 9:30, it was just shy of 4.5, so that's retreated now to about 55 basis points. And you are more or less in line with your benchmarks, your custom benchmarks, slightly above that. On the following page, and you can look at this again, we'll have some more finalized numbers next time, and that will include November as well, which I think will be insightful and instructive. You'll see the asset class returns for each of the various composites. I think the U.S. equity composite obviously is a highlight. Vince already mentioned the lower beta defensive nature of how that particular composite is constructed, and it's performing in line with expectations and as designed. So despite this, the negative 6.7% return, 70 basis points ahead of the benchmark in this type of environment. So it protected quite nicely. Non-U.S. equity underperforming a bit and has more of a negative absolute return. You're seeing some underperformance in the developed small cap space and emerging market with William Blair in particular. Fixed income composite continues to do very, very well. Gave up 30 basis points, but almost 55 basis points ahead of the benchmark there. Non-core fixed income is one of the few asset classes that was positive. That's quite helpful, and interestingly enough, cash is the second highest returning composite, so we haven't seen that in a while. So that's the high level. Happy to take any comments or questions that you might have, but hopefully come back next time with some better numbers.
What was the attribution in non-core performance? What was that primarily derived from?
Bart just worked that up for us. Bart, did you do it through October or through September?
I just have numbers through September, but in general, in October, where we'll benefit is publicly traded high yield had a really tough October. We don't have a lot of exposure there. Our exposure is in these private funds, which did better in our non-core. So it's really the investments we have in non-core versus publicly traded high yield will be our relative gain.
It's pretty broad. You can see it on page 7. I think there is one particular driver per se on page 7 of that report. You see the underlying components, and you may remember that we moved the absolute return composite into that. That's helping. We just more recently moved the bank loans in from the financial real return composite. That isn't helping, but you're seeing that as you're looking across unconstrained, all of them are contributing to some degrees, but there wasn't one major outlier that I would attribute to.
Thank you.
Very good, thank you. All right, so that's our performance scorecard. And we'll pick up the month of November, I guess, in our annual meeting. If we have any flash on December. Okay. All right. I guess we'll move to Jack.
It'll be Seth covering the real estate and real asset PMR. Before I turn it over to Seth, I just want to follow up on Member Tyson's comments about performance. This our 1-year number in the real estate portfolio is 3.3%, right, of performance, which translates to $66 million. So it's real money, and over 3 years, it's roughly $120 million. So the decisions that the committee makes here and the guidance I get from Vince and the work that Townsend does, and of course my predecessors, because I've only been here for 2 years, it's really had a great effect on our overall portfolio. And that's with a portfolio that's no more than 40% non-core. In fact, we're just barely now getting up to the 40% non-core level. So I think we shall be very happy with those returns.
So I'll talk about real estate first and also keep this pretty brief. When we think about the performance that Matthias just went through and Vince as well, that was third quarter. This is actually back to second quarter, so we're going back all the way to June and sort of the back up your minds of what was going on in the first half of the year. So it's a little bit stale, it's much obviously backwards looking, but we started in the page number I'm going to look at is in the bottom right-hand side of the Townsend report, on page 4, which you've seen before, portfolio highlights as of the second quarter. Here, we do look at the performance table in the middle, and you'll see the quarter 1, 3, and 5 year performance with the outperformance numbers on the bottom. There is, for the first time, a red number on this page in a couple of years, so I'll address that real briefly. So it's 10 basis points over the current quarter of underperformance on a net fees basis, 1.7 versus 1.8 in the benchmark. And this is really due to, obviously, short-term quarterly volatility, but we dug into that, and that is mostly attributable to currency movements. So over the last couple of years, we've seen positive currency movements from the US dollar perspective. We gave some back in the quarter, and I'll talk about some of the specific numbers in a little bit, but that really did move the quarterly number significantly down for this second quarter performance. Also, you'll see that this did not materially impact the 1 year number that Paul just mentioned. So we're still at a 10.8% return over the 1 year, although this doesn't include a quarter of underperformance and 330 basis points of outperformance over that 1 year time period. We do tend to look at the longer term, so 5 year number is really what we focus on, given that typically includes life cycle of some of these investments and funds, and we have 160 basis points of outperformance there. Again, we're showing double-digit returns over the current year, exceeding our projections of 7 to 9%. So we're seeing strong benefits of the alpha that's being generated through investment selection and allocation of the portfolio. And in past reports, and consistent with this one, we do show an attribution of all the individual positions later on in this report that have to answer your questions about. Another comment on the first bullet here, we're at an 8.9% allocation as of second quarter. This is basically flat quarter over quarter due to some large distributions we received from some asset sales. We talked about in the past, both in the industrial portfolio as well as an office property in New York. Both were 2x multiples, large IRRs, where we got about $3 million back in each investment position. So that sort of kept the allocation consistent. Obviously, with the movements in the equity markets, we'll see some changes in there, likely by the end of the year, due to the denominator change in the plan. The rebalanced portfolio now is 96% of the total real estate portfolio, so just 4% is in that legacy portfolio, which we still do follow closely. So it turns into about $80 million of net asset value. 3 of those positions in that portfolio are about 70% of that, so some of them are very small, but 3 of them are pretty large. Each of those managers we're in constant contact with. They are having realizations. For instance, there's one student housing investment that just in a matter of the last 24 months has sold 14 properties out of 28 total properties. There was also sales before this. There's only about 6 properties left in that fund. So that one is liquidated. That's one of the larger positions in the portfolio, so I highlight that. The other thing I mentioned, I haven't mentioned this in the past, a number of those funds, not all of them, but a number of those funds are beyond their life cycle, so beyond the term of the fund. In those investments, we are no longer paying management fees. So there's no fees going out the door. Those managers can continue to manage those assets and sell those assets accordingly with the strategy of the fund. Jumping to slide 6, we talk about a little bit about the investment pacing. Paul mentioned that we are sort of fully allocated now to 2019 with the approval today of Blackstone. We've made a couple pre-year-end commitments that are not going to be available come calendar year 2019. So we've committed just over our planned pacing. And we will continue to evaluate opportunities. We're not going to stop looking at investment opportunities. Markets change, markets shift, numbers change. So we continue to be in the market and look at investment opportunities, both with your existing managers and new managers throughout the year. But from an investment pacing perspective, we are fully allocated for 2019, fully committed to 2019 after the investment today with Blackstone. The last point I'll make is you've seen before, but on slide 8 is the fee savings that we talked about in the past. The new commitments that were made this year have not yet been added because capital hasn't been on. We anticipate, so today we're at about $2.4 million in annual fee savings. And these are fee savings not just based on, so New Mexico earns and generates fee savings because they make larger commitments to some of these funds. They achieve fee savings on their own. Those fee savings are excluded from this chart. This is just from additional negotiations that we've had with the managers through Townsend client base, direct conversations with the managers that, we feel that, because of longer relationship with the plan, or with the fund, that there's additional fees that should be, additional fee savings that should be generated, and that's what's included in this $2.4 million. The commitment to Asana, which was made a couple months ago, will be added to this, and we anticipate this number being about $2.5 million come 2019. And then it's on an annual basis, not just for one-time fees. The remainder of this presentation you've seen in the past, as I mentioned, there's a number of attribution charts in here, as well as portfolio construction and contributions to returns, but I'm happy to answer any questions.
Okay. It's outstanding again. Congratulate ourselves on our good decision and hiring you guys.
It's a team
effort. Okay, well, let's go over to the real asset, demo.
So as, again, this is also 2Q performance for real assets, that includes timber, agriculture, smaller allocations from the portfolio, and then mostly in energy infrastructure, is really what this portfolio, really large, significant portion of the allocation was. This inception was 2011, so we're looking at an 8-year portfolio. All, as we all know, has been in a positive market environment over these last 8 years. So anticipated to have seen strong returns here, given the inception date. So we've committed over $2.3 billion to 31 individual fund investments. This is across 18 managers, so a lot of follow-on or multiple strategies with the same manager across those sectors that I mentioned. On slide 5, we highlight the commitment amounts that we've made over the last few years. You'll see there are, in the early stages of this portfolio, we were over-allocating, because it was a strong point in the market cycle that we thought was appropriate, but also because we were building up that portfolio. Today, we think more on $200 to $300 million is appropriate annual commitment levels for this portfolio. And then in 2019, at $211 million, we actually made one of those commitments last month. You'll recall with BlackRock Energy and Power Fund 3, $100 million. So that was sort of forward committed a little bit here as well. And we'll likely look at one, maybe two more investments in 2019. We likely one in early in the first quarter, follow-on commitment within the infrastructure portfolio. The target here, the allocation here is 9.6%. We're at a funded level of 6.2, and that's actually up from 5.3% year over year. If you look at 2Q 17 to 2Q 18, we're up almost a full percent, about 90 basis points in that from an allocation perspective. So a lot of capital is being called and invested. A lot of these funds are long life vehicles, either open-ended or 10+ year funds. These are infrastructure and energy assets that are long life funds. So that capital will be out for a long time. And they are very chunky and large commitments and large investments that are being made. When we include the unfunded commitments that have been made, we're at 9.8%, so about 36% unfunded. That's taking advantage of investment opportunities today. And much like the real estate, the target allocation, we do continue to make investments to achieve that 9.6% allocation over time. We're not looking at there overnight. We've closed on a number of commitments this year, and as I mentioned, the BlackRock commitment will be considered 2019. Slide 6, we highlight the 1-year performance. And I think I said this last quarter, and then I'm going to say it again. We'll likely change this chart to look at a longer time period now that the portfolio's been around for a little bit longer. The 1-year numbers tend to be quite volatile, especially in this sector. We are showing a 7.4% total return over the 1-year period of this portfolio, mostly driven, as you can see, by infrastructure and energy. Those are the large allocations, but also where a lot of the return is being driven by. We see both timber and ag being slightly positive, slightly negative, and less than 1% in either direction. There's a couple of reasons for that. One is within the ag portfolio, the agriculture portfolio, we do have international exposure. Like I mentioned, in real estate, there's some Brazil exposure there. There's one investment specifically that was written down 14% due to the currency alone. So the investment itself was flat, but the currency depreciation was 14%. So that's impacting that agriculture number. Also, those investments are still, I say they're still in the J curve. Both energy and infrastructure are out of that J curve. At this point, we're actually seeing distributions back from some of those investments. as well as new capital being called. But the timber and agriculture is still, they're still in shaker, they're still producing, we're still looking for new investments. They're much slower to commit, because of the pricing in the market today, they're being patient, which is a good thing, but also we're paying fees in some cases on committed capital, so we're looking at ways to reduce those commitments potentially going forward. But at the same time, those are again are long life funds, some of them as long as 15 years. So being very patient on how they're executing. A lot of those investments within the fund themselves that the capital has gone out are being held at cost on 1.0 multiples, 1.1 multiples. And that's really because it's so early and the value creation is taking place there. So we'll see those numbers change over time. The remainder of the slides, again, you've seen in prior quarters. There was no significant events to really highlight other than what's on slide 7. There's a couple things that we follow on. There's been some manager changes in some of the funds that we follow very closely. So we'll keep you apprised of any significant issues there. But we're comfortable with the teams at each of those investment advisors that have seen some turnover. Then the remainder of the portfolio, or the remainder of the charts, you've seen in the past, and more of a summary of the portfolio. So I'll get to the question.
No fundamental thesis change in ag and timber. Or is that to be determined?
I think, our plan is to stay with what we've got, basically, and as as I've been talking to Vince, we've got one timber strategy where we might pull back a little bit, but other than that, we'll stay with what we've got. I don't see us making new commitments to timber and ag, but it's been a bit of a challenging space lately, and it's, just there's all these weird weather things that happen that affect, fires affect the quality of the wine grapes in the Napa Valley, and windstorms affect timber harvests, and rain affects the ability to get at the timber. So there's a lot of, apart from just growing stuff, there's a lot of things that happen environmentally that affect the business. And added on top of that is, the vagaries of international trade. We get commodities like soybeans and things like that, and tariff responses. So there's some sort of unpredictable things that go on with our ag and timber portfolios, but they are good anchors to the real asset portfolio, and they're never going to be a huge part of our portfolio, but I think we have a place in them.
One thing that I think you might be interested in is this spring when we start talking risk and kind of build our way up toward the annual plan is, we'll talk a little bit about over this last cycle, how financial assets have just gone parabolic while real assets have been this. And so we feel like we're buying this and holding, not that it's going to go parabolic at some point, but things that have gone parabolic often come back down. So we think this area, particularly this area, is fairly washed out, and we think we bought assets that, over a full cycle will do well, and probably over 2 cycles could do quite well.
The only other point I'll make, we brought the real assets allocation study earlier this year. We did reduce the target up with the cap on those timber and agriculture to 15 to 20% respectively. They were much higher. They were up to 3%. I don't know if the opportunity exists in this size portfolio to be up to that higher level. So we're not looking to Paul's point to make additional commitments in the sectors.
All right, private equity.
Thank you.
Thank you so much. Richard, I do that.
Good morning, Dave Lee, Private Equity Director, and Richard Putmeyer, the building, soon to be another name. We have the second quarter private equity performance report, and we'll turn it over to Richard to go over a brief update.
Now, if you turn to page 4, I'll just stick on this page because of time, and then open it up to any questions and just the highlights for you guys.
Page 239.
So, looking at the since inception numbers first, and then I'll put it into more context by talking about what's happened over the last year. You look at the since inception net IRR, it's increased over the last year from 11.2% to 11.5%, which isn't a big
increase, but that's over a period going back to 1988. And this last year has been really strong. But you look at, since inception of the private equity program, it's generated 1.9 billion of gain. We've contributed just over 4 billion to the funds. They've distributed back almost 3.8 billion. To put it in context of what's happened the last year the NAV was about 1.8 billion. Now it's about 2.2 billion, so $400 million difference. What caused that increase in 400 million is you had contributions exceed the distributions you received by about 100 million. So that did it, and the remainder of that, about 300 million, was gained from the portfolio, which equates to about a 16% one-year net IRR. So performance has been really strong in the portfolio. Distributions were about 340 million over that one-year period as well. We're starting to see distributions come back from the funds the commitments that were made from 2011 and after, in addition to those more mature commitments that are still in your portfolio. And from a benchmarking perspective against the private equity benchmarks, you're above median in those vintage years, 2011 and after, since discounts have started over some of the private equity commitments. And then on the PME basis, that's still lagging behind the public equity. As of June 30th, performance has been strong over the last 10 years in the public equity market. Just a couple of things of concern that we continue to watch. There still is a large exposure in 2009 and before vintage year funds. So we're still watching that distribution pace. We want to try to see it increase. A lot of these funds that become over 10 years, there's different action items that we have to advise on. And we're looking at trying to get liquidity as quick as possible, but also not compromising any value, not leaving any value on the table. One other thing is just the pacing. We did 4 commitments this year for $285 million. That was below our pacing target of $550 million. There's a couple reasons for that. I'll hit on some, and then David will hit on some others. One of the things we do is, as we plan these fund commitments, is we do a forward calendar. We actually look at what's coming into the market, compare it to this year and next year. 2019 is a really strong year of expected fund commitments for you. There's a number of re-ups and some new relationships that we're targeting, and so we didn't want to use a lot of the capital this year when with market volatility where we might potentially have to come in lower next year. Also, a lot of the 2017 fund commitments that we made ended up drawing capital for the first time in 2018. So you actually do have quite a bit of exposure to 2018 vintage year funds, even though you didn't make that type of the approval within the target range. Also, in addition, there's about 1.4 billion of unfunded commitments that are out there that are contractually obligated to contribute to these funds. So you still have a big balance out there that can potentially be drawn, if there is a downturn and there is some type of decrease in the distributions. We've seen a lot of distributions come into the portfolio. We still want to see more distributions from the more mature, but we're just being conservative in that sense.
Yeah, and the commitments, we make the commitment sizes, the pace based on the fundraising cycles that Richard talked about. We're dealing with partners and potential partners that usually raise funds every 3 to 4 years. So depending on the timing of the quality of the partners, 2017 versus 2018 versus 2019 can be pretty different. And one of the things that we're cognizant about, besides the unfunded commitment, which can make this allocation swing fairly wildly in the case of correction, is the fact that we are effectively in a late cycle. You've heard Vince talk about that many times. We see that in the markets all the time in terms of the multiples that these managers are paying for the investments. We see it in the ability to access leverage without covenants. And the managers are doing the best that they can, but we think that given the fact that we are a late cycle and given the fact that we are an investment cyclical industry, we do try to be a little bit more selective and judicious at times to try to bring the best managers to you. And if that means having some of these dollar amounts slip from one year to the other, we think that's the most prudent thing to do.
Any questions?
Yeah, any questions of the national program? Okay.
Keep it up. Keep it up. It's looking pretty good.
Sun Mountain? Mexico project, please.
This report starts on page 253 of the bill. Obviously, we have this on Mountain, we ran Sally Plummer and Brian Lewis.
I'll call out the titles and since our page numbers on that, so I'll be able to from around, so thank you. Appreciate the time, everyone, we'll try to be efficient. This is the New Mexico Q2 2018 performance summary program status. Just as a quick overview, the overall program is at 2.5% IRR, so that's continued to climb, so overall nicely positive. And the non-legacy portfolio is sitting at 9.9% IRR, so since 2007. We are well under the statutory cap, which is interesting only in that it provides available capital for interesting opportunities, so we are no place close to that, which is good. And we are tracking still at the 5% council approved allocation, so we're at 5.5, that is trending down. And the second quarter distributions were not quite 2x, but definitely higher than the outflow, so that's good. Do it, skip the next page. We'll go to the New Mexico Peak historical financial performance summary, so a couple of graphs. It's essentially saying the same thing we just said. Just wanted to point out that we have a graphical representation, so that's easier for you to digest in the numbers. You can see how the overall portfolio and the legacy and post-legacy are performing. The next page, the Q2 benchmark summary. Again, you've seen this before, but I think the key thing to point out is 4 of the 5 vintage years post 2007 and ROE, so 80% of it. So again, we're giving you different ways to look at the performance. The punchline across all of it is good. The next page, New Mexico Peak economic impact since inception. Obviously, we managed this to make money and hit the financial return targets, but it is worth noting that there are material additional benefits. So you've seen this story before, but for every dollar that essentially comes from the council, about $6 comes in from funds completely unaffiliated to the state. About $2.5 billion has gone into companies within the state, and the punchline of all of this is it's really helped to create and continue to nurture and support a rapidly and exciting growing entrepreneurial ecosystem within our state. So this is a nice thing to see where we all live. I will skip the next slide and the next one and go to the summary of key points for the program. Again, I think we've hit this, but we have seen a material uptick in the quality and caliber and level of investments since the changes made in 2016. So that's continued to let us do what we were hoping it would do and get into good funds and opportunities. We have a number in the pipeline, 3 that are moving their way through. And as we said, other than having positive financial returns, there's other benefits coming out of the program. That's very quick, high-level overview of that, and I'll turn it over to Sally at this one.
Sure, good morning, and I'm now going to focus on tranche 2017, that's my page 11, on which
260.
263, okay. As of the Q2 2018, the Focus Fund tranche has funded 7 new companies and has made 5 follow-on investments in existing portfolio companies. And then subsequent to quarter end, tranche 2017 made 2 additional investments in New Mexico-based companies. So that's a total of 9 companies. And although it's only 2 years old, tranche 2017 has had early portfolio write-ups and resulting in really a very early promising track record. It's essentially a net multiplier of 1.5 times. And with the 9 new investments, tranche 2017 is now fully committed and reserved. And at this point, because of the reserves and the commitments, we are unable to make new investments in opportunities that are coming our way. So we're gonna, just be thinking about that in terms of what's gonna happen in 2019. Because we are, as I'll show you in a subsequent slide, we are seeing a lot of interesting opportunities. So then if you'll turn with me to the next page on 12, I'll give you a Catalyst Fund update. The investment commitments are on track with the Catalyst Fund pacing plan. 6 funds have been publicly closed on those commitments from the Catalyst Fund. 3 funds are in the early stages of due diligence. And the fund has capacity to make 1 to 2 more fund commitments. And we've really been very encouraged because the funds that have received commitments, they're with experienced investors in their investment communities, and there's pretty broad industry diversification and geography. We continue to look at opportunities outside of the Rio Grande corridor. And then finally, on page 13, we just wanted to highlight that there's certainly a lot happening in the New Mexico startup ecosystem. These logos represent some pretty interesting, what we would term kind of high profile New Mexico opportunities. And this trend has continued into 2018. Over $128 million has been was employed in 2017. And lots of these rounds were multiples of $5 million or more. So we're really encouraged with what's happening in the ecosystem.
Okay.
And that's really all we have in terms of a summary, unless anybody else has any further questions.
Are there any questions? Okay, very good. Thank you for your time.
Thanks.
There are a bunch of Section 3E reporting items that we usually don't discuss these at the meeting. But if anybody has any questions about them, now is the time. Otherwise, we'll move to Steve's report.
No questions. Over the past 12 months, you have distributed $928 million to the state from the land grant and severance tax funds. West Texas Intermediate Oil yesterday closed at 51.59. It's been quite volatile, as most of you know. The New Mexico price is substantially less than that due to primarily lack of ability to transport product. Net asset value as of close yesterday was $23.6 billion. As I look at the sheet that I provided you with my report, I think it's important to note the land grant permanent fund inflows from the state land office under C, operations. The previous high in October of 14 was 73.9 million. October of 2018, 83.48 million. Quite an increase. Then take a look, if you will, at the investment holdings report final page. And I'll just recite this for you if you don't have it easily in front of you. Page 318. The monthly contribution from the state land office of 83.4 million is an increase of 11.9 million from September. For year-to-year comparison purposes, the October 17 contribution from the state land office was 38 million. Pretty remarkable numbers. In terms of what our clients have been doing, I think it's interesting to note the Retiree Healthcare Authority contributed $10 million and rebalanced all their investments. They redeemed their investment in Core Plus bonds, contributed to Core Bonds pool and the Real Return pool. That from the investment holdings report. You'll note that we had no meetings in December. We wish all of you a very pleasant holiday season. We are continuing to source a public equity analyst. Starla's working hard on that, and I'm told you have a couple of prospects. Great. in terms of external relations, I call these community forums when we get together in the various communities and try to educate our citizens about how fortunate we are to have the permanent funds. We met with the Los Alamos Chamber and then with Los Alamos County's folks that monitor the investments that we have for them on the 13th of November. Charlie and I drove up there on a very cold, icy morning. The turnout was not outstanding, but we had 10 or 12 people there. They were all interested, as you might imagine, for Los Alamos County. We'll be driving to Las Vegas, meeting with the Rotary there and with Highlands University personnel on the 18th of December. And we're still planning a trip to Clovis, if not in December, right after the first of the year. We will invite Scott to come from Portales for that meeting.
Oh, that way.
We are providing information to the transition team, and we'll also be asking to do new legislators briefings as the session begins. We have our quarterly sovereign wealth fund collaboration call with the 11 or 13 funds around the country. We're still trying to determine what the number is. On the 10th of December. And then, interesting for all of you, I think, is the topic legislation. Treasurer Eichenberg was present yesterday when we met with the Investments and Pensions Oversight Committee, IPOC, and presented a possibility for the state to invest the tax stabilization reserve, also known as the rainy day fund, which will for the first time be funded this year. The possibility of the SIC investing that, as the statute reads, the state treasurer's office is to invest those funds. We've been asked by a few different people, a few different offices, to consider whether the SIC would be willing to manage that fund. And in response to that, we have worked with the Legislative Counsel Service. We presented a bill to the committee yesterday. And I'll ask Vince here in just a moment to discuss with you what he presented in terms of possibilities for returns. Representative Tomas Salazar, who chairs IPOC, has offered to sponsor and carry this legislation. Investments and Pensions Oversight Committee endorsed it in the event that you all believe it's something that we should do. And we do want to ask you today whether or not you're willing to endorse our doing this. Vince, if you would mention what we think we might be able to achieve in terms of excess return.
So Matthias and I ran some simulations, and you've seen that work when we do asset allocation. We ran that same sort of simulations based on their long-term forecasts or long-term assumptions on rates of return. We think we're in between the 4 and 5% area on a portfolio that would provide the liquidity and the safety in terms of the investments that they need. So something around a 4 overall. So pension funds here are 10 to 11 volatility, and we're 13.5 volatility. This would be a 4 volatility. So quite safe in terms of price change and things. But between 4 and 5%, we think over the long run, at least based on current assumptions. Of course, as interest rates rise, that number goes up over time.
And that would be oriented toward which of our pools and what kind of liquidity would you think they would be looking at?
Core bonds and non-core bonds primarily, those two pools. A good slug goes into the low duration to provide that super liquidity. Peter, when I ran the numbers, honestly, I think this fund could go as big as 700 or 800 million before we have to worry about liquidity at all, based on the asset allocations that Matthias and I were looking at. if it gets to that level and the permanent funds haven't gotten any bigger, so if we're still here at 24 billion, but that fund gets bigger above 7 or 8, we could have, so instead of monthly liquidity, we might have, every 2 month or 2 months or 3 month liquidity in just the real estate section, I think. The others I still think can produce monthly liquidity. Much higher than that, they're starting to have trouble with non-core space. But the way the allocations came out was only about 20% would be allocated to real estate portfolio. So 80% of the portfolio has monthly liquidity, even at $700 or $800 million.
So how were the investment objectives for this fund articulated to us when you did this analysis?
They weren't, other than it's a reserve fund.
We did,
Right. So they weren't, other than it's a reserve fund. So, but when Matthias and I were talking, we said 4 to 6 on vol, that's all a fund like that can take.
So, does the draft legislation include any investment objectives?
No, and we talked about that a little bit. I'm leery of that.
Okay.
Peter, I'm leery of putting any sort of restrictions in the bill, because you all can put as much restriction on.
So we, it would be up to us, or would it be up to Duffy, or who would be? Yeah, us, okay.
We continue to have this conundrum about who our
Who's the
client
client,
is. Yes. And can we get any clarity in this matter as we consider taking it on and knowing what our client's investment parameters are? I think it would be highly advisable.
Well, this is probably more Steve or Charlie or Evan's area, but my opinion on the way the bill was drafted is it's very clear that, we manage the money, so we would decide all those things. There isn't a client to go ask.
Charlie, why don't you comment if you would?
Well, we kept it fairly short and clean as far as the bill goes. As you know, we're all governed under Uniform Approved Investor Act, which does contemplate items like liquidity and the purpose of the fund. And so I think we would do some analysis to kind of develop a long-term outlook. And we obviously get opinions from the Treasurer's Office as well as LFC and DFA as to what the expectations were for this. I think all we identified was that 2% is kind of what the short-term return would be, and we could take a longer-term approach and get it closer to 4% with minimal risk. Obviously, this is uncharted territory, so we're willing to take guidance, and the more opinions we get to the table, I think the better off we are.
Well, maybe this is aspirational, but it would be helpful to have a designated representative to dialogue with us on objectives like liquidity, and that could be DFA, it could be LFC, but it would be nice to have a designated representative on behalf of the objectives of the fund. And it would be nice to know, for example, what the liquidity objectives were, what the tolerance was for duration, what the tolerance was for non-fixed income types of investments.
So I think, my sense is, once this bill passes, the council could establish a dialogue and policies that would, for example, look to DFA for guidance and have a vote on what we're doing. But I don't think we have any problem applying judgment. I mean, that's what we do.
No,
Going with $24 billion, I don't know.
Well, we enter into, what do we call our agreements with a third party?
Everyone told us that.
What do we call
Joint
it?
powers agreement.
Okay, we would enter into a joint powers agreement with respect to this?
No,
What about an MOU?
Yeah, what about it in
A little less formal. I agree 100%. Somebody outside of this room's got to sign off on this thing just to protect us in the future. Because it's not our, somebody's our client here, it's not our money.
No, we've never done that with the tobacco.
But we had a big issue with that tobacco funds when it started to get swept, as I recall, because we were confused. And I guess I should speak for myself. I was confused because I didn't realize that that was anything but a permanent fund. And then when it was designated as being liquidated, it wasn't invested that way. And I don't know what sort of problems that causes, but that's paramount with respect to this fund.
The tobacco fund has been invested like the permanent funds for the history that we know of, the history that we know. It's been invested like the permanent funds. That's a little less consistent with the purpose of those funds as reserve. So that's the question we were trying to ask is, does somebody know, should we continue to invest this as a permanent funds or are invested? And that's the question we had trouble getting answered.
Technically, is the sort of the owner of that tobacco fund, would we consider them to be the same owner of this emergency reserve fund? I would say yes. So I don't know, just to protect this council in the future, because I can just see if there came and we invested a certain way on our own here as we decide with no sort of sign off by anybody above us in the organization, so to speak. Then we have to liquidate it and something goes less than positive given situations that perhaps occurs, and all of a sudden you can have a bunch of political issues focused at this council that in my opinion would not be fair. To me, there just has to be some understanding of some state agency about ultimately how we decide to invest that just for that purpose.
What would be DFA? Yeah, I think it would be DFA, and I think we would establish a writing that sets forth our view of what we're trying to do and why, and obtain a consensus on it.
Yeah, I mean, I think ideally the best practice would be for DFA, for example, to give us some general guidance on risk tolerance and range of return expectation. And we would then execute our investment judgment to meet those goals and objectives.
Okay.
Do we even know if we can ask for money out of the fund?
Only the governor with 2/3 majority.
Okay, so we do know how, and we're looking at investing the entire amount of the funds or a portion? Entire amount.
Debbie, do you have an estimate of what you think might be coming into that?
Well, there's 162 million in that fund right now. It moved from the other tax fund into the tax fund.
And where is that money?
The treasurer's.
Okay, the other point that was discussed and was brought up by Don Iglesias, who is our analyst from the LFC, is the fact that the earnings on the rainy day fund, as currently specified in statute, go to the general fund. And if there is a desire on the part of the legislature to have those earnings revert to the fund as opposed to going to the general fund, that's a change that would need to be made. Charlie, was there anything else brought up yesterday that we ought to discuss?
No, I mean, these are early days as far as, we did get an endorsement from the committee, we appreciate it. The chairman, very pleasant and excited to carry this bill for us, and he has shown a very even-handed temperament. We appreciate very much at this committee. And so we got what we want, but we're certainly willing to make the best possible bill we can headed into what we expect will be a very busy session.
Is this going to affect our bond rating to have a rainy day fund? And if so, will the manner in which it's invested affect the bond rating?
It's already had a positive impact on our bond rating. Just creating it, and probably next month it'll have another positive impact because we already have money in that fund. The investment of it would impact that. They would want us to get a return. And my assumption is, and I can certainly ask the rating agency, but my assumption would be, their preference would be that the earnings stay with the fund. and not go to the general fund.
That doesn't, we were just chit chatting about that, that doesn't make any sense that those earnings would go to the general fund, given what this is designated for, it's not logical.
When the treasurer's office invests, enlighten me, I don't know the answer to this at all. I mean, how is that money invested by the treasurer's office? In what?
It's mostly short term.
And is that 2% yield a
Well,
reasonable
that's,
target?
well, 2% is what I get on cash. Okay, we have almost $700 million in cash. 205 basis points as of last month. You know, some of the things that the committee talked about yesterday was the liquidity aspect. You know, I certainly was very, in my one-on-one conversations, that the interest earned should go back to the fund. And she's going to show. That's how we track that. And I'm excited about it, whether it's in my office or the council. But, you know, I always thought legislation, you know, so I'm going to take a half a step back here, but I always thought proposed legislation bring to the council before it went to the legislature. So am I wrong on that?
What is the status of the legislation? Is it in draft form at this point?
Well, they had to introduce it in the draft form where they couldn't get an endorsement. So the bill's been written, but I haven't seen it. I don't know if any of you have seen it.
Charlie, we've been,
Last couple
we
of months,
published
it's been
this over the last couple of months.
May one.
Oh, yeah, you discussed it, yeah.
Oh, no, it's been shared with the council.
But it's never come to the council.
I don't think we've ever seen a draft of the legislation.
Yes, you have,
We have?
yes.
I'm sorry, I missed that.
We set that out, right, Charlie?
Yes.
In one of your
And
reports?
we discussed it here in a public meeting? I mean,
I have discussed it as part of my report, yes.
We've talked about it several times.
We had,
So it will now be finalized, given IPOD's endorsement, is that the next step? The
We can-
legislation will be introduced in a finalized
Finalized.
form?
Basically, it will be introduced, assuming, you know, we hear what we're hearing today. If the majority of you agree that it's something we believe can benefit the state, you know, we're willing to take it forward, working with our sponsor, working with the treasurer's office. We certainly want his support if at all possible. We think it's a tool that we can add to the state's toolbox.
Well, I certainly would endorse it going forward as a member of the council. I would like to see the enhancements we've discussed incorporated.
Yeah, well, I think we should provide a sense of the council to Charlie of endorsement. I guess Tim's in favor, you're in favor. Harry?
I'm not in favor of it because I haven't seen it.
So
Okay,
you're,
so
so you're not endorsing.
I haven't seen it.
So,
I am prepared to endorse it in principle if we can create a responsible 2x return for the benefit of the state. I think that's advantageous for the state. On the other hand, I do want to see the definition of objectives and an identified partner to be working with as our client.
all right, I hear you.
I'm also, was gonna just add, I tend to agree with what Lynn just said. Lee and Tim, you did send the latest copy to Tim and Lee and me as kind of quasi members, I think, of the old legislative working group, is my guess.
that's because Lee requested it.
Right, I haven't seen it.
Copied the
I have not,
two.
and I have not seen it in a council communication. If I missed it, it's my fault, and I'm sorry. I don't think I've seen it in a council submission.
How many times have we sent this out?
You know, I have to look.
At
You know,
least once.
we have shared it in the weekly report.
In the weekly
Steve has referred to it the last two times he's had a report to the council.
Lee and Tim and
Not
I,
everyone was here for that.
sorry, Lee and Tim and I also agreed that the language of the bill, there's a couple of things that I thought could be different. But the concept, I think, is phenomenal. The idea that the SIC invests that money. I have no problem with that.
I'm sorry that you did not see a copy. Charlie did include it with the weekly a couple of months ago, maybe a month ago. Here's what we'll do. We will send it out again this afternoon to each of you. Please take a look at the bill. We've heard the changes that you believe should be considered, and we'll try to make this work. If you have problems with the bill, let us know. We're certainly not going to ask you to endorse or say that you're in favor of anything today that you haven't read, and we'll go from there.
That makes a lot of sense, and I would just say generally, it's, I love Charlie's leaflets. I think they're some of the best communications we get, and I enjoy reading almost every one of them, but I confess I don't always read to the bottom. So I think if we're going to communicate with the council, as we have now decided to do in lieu of having a legislative working group, we should do it via Carrie's distributions to the council, not in the weekly, because they sometimes get lost, to be honest.
Okay. Linda, Scott are also positive.
I like the idea of getting a better return for the state. I likewise am concerned about who our client is to assure that we are investing in the manner in which they want, and that we know who has the authority to do it.
I agree. I don't have a lot of hope for, I think that was something we discussed at length as to whether or not it made sense. I think we have to be cautious about trying to identify a particular client.
But the challenge there, and we all know what happened, let's assume they aren't able to do that, then
Right.
something happens, and then you have people screaming, well, geez, yes, I see.
So we take some criticism. So we're criticizing. We're investing $24 billion today, and if when the market craters in the equity side for another 30%, we're going to hear a lot of criticism. You know, and that's why we're here. I can handle it. I think we all can handle it. If we invest this money that Tim has suggested, we can double the return on. He's constrained, and we're not. We do it with sense. We confer extensively with Duffy and DFA. I think asking somebody, I don't know who that person would be. Who are you going to ask for a buyout in the state? The governor, the legislature? I mean, you're not going to find it. So I think we have to be realistic. I think Steve has heard the comments, and we'll see what he can suggest. But I think, I don't think we're going to see it just as we found with the tobacco fund. So, yeah. And that's why we're here, guys.
And on our permanent funds, we have a distribution rate. So when the market goes down, our distribution amount just goes down on that 5-year rolling. Here, and it's more like the tobacco fund, the rainy day fund usually gets hit when things are not good. When things are not good, our investment return may not be 4% that day, it might be a -2, and they say, we want 80% of it next month. That's when the criticism comes. I mean, if we were just saying a distribution rate, that's more.
Let me just suggest, I think we're getting ahead of ourselves. I think let's see if we can get the responsibility for handling the investment. We will then have a robust discussion of what the policies and procedures ought to be to assure that we're prepared for the kinds of situations that you identified. And we will have to take it on. I think that's terrific that we have this kind of resource for the state to take this on, as opposed to, think about the alternative, guys. None of those are very.
When you think about it, this is a simple choice when you get right down to my mind. Either, and this is not, there's no criticism applied or intended here, either stays in the treasurer's office and the short-term rate is what's made, and that's where it is, or it comes over here, and the understanding has to be that in order to get more than that kind of return, there's going to be risk. And as long as that's very clearly stated, it seems to me that's as simple as it needs to be.
But remember what we're doing. We have established an office of 30 very professional investment people, guided by a council that I think is pretty professional, pretty experienced. The alternative is to turn it over to somebody in government here. And I won't go further.
Let's, I think we can let that one go.
Right. Okay, guys, so, if there's heat, we'll take it. All right. Moving along. All right, very good. Brad, I think you've got a report. Yeah, Jim has, oh, of course. And by the way, I again want to compliment Jim for sitting through these sessions so that he can represent the audit committee. We're very fortunate to have his time and commitment to the audit committee. And particularly this last one, since I was totally unavailable. Jim handled a lot of it.
We had a couple of challenges, this last month, okay, and I'll go through and do this, because I always want to go. We had a couple of challenges. This year was the first year that we had Moss Adams back, okay? And it went very smoothly. However, we had originally planned on, and I think that they were a little overzealous, that we would have a meeting, I think on the 5th of November there. And then we got up to right at the 5th and we had to move that to the 14th, okay? And so that conflicted with some folks' schedules and so forth. So we did have an audit committee meeting on the 14th of November. The audit committee was there. We did not have a quorum there. And of course, SIC management was there. And then Moss Adams participated in that. And in your packet there, back on page 319, you don't have to go to it, but back there is a deck in there that they gave us during the meeting there. And it's a pretty well done deck there. Did something a little bit different than our prior auditors did. They put a section there about the areas that they focused on, which and they focused on the areas that the audit committee suggested to them that we consider to be risk areas there, and they did, in my view, a very thorough job in those areas there. They completed their work at that date. And they were prepared to issue the financial statements at that time. And those financial statements will be issued subject, after the state auditor gives their approval. Moss Adams reviewed with us their required communication. And there are kind of 4 points that I want to make sure that we all know about. There were no difficulties encountered with them in performing the audit, number 1. Number 2, there were no disagreements with management. Number 3, there were no corrected or uncorrected audit adjustments, okay? And then number 4, there were no material weaknesses or significant deficiencies noted in the internal controls. So those are four things that I think is key for any audit committee to look at, and I think it's a key for the council to be aware of and put a check by each of those. They apprised us that the financial statements have been prepared in accordance with generally accepted accounting principles, and that they were in a position to issue their, what we call now, we used to call their clean opinion or an unqualified opinion, and over the last few years it's been changed to say it's an unmodified opinion. Some of the people that do this stuff have too much time on their hands, but, and so,
I kind of like unqualified.
So it's unmodified, so I'm old. Moss Adams was extremely complimentary of management at the SIC, and particularly of the accounting organization there, of Brent and his staff. After the meeting was over there, unfortunately, I was in New York, and so I was doing it telephonically, and I do not like to hold executive portions of a meeting telephonically, because I can't tell who's on the phone and who's not on the phone. And so subsequent to that meeting, I had a executive session with Moss there, and they were extremely complimentary extremely complimentary in that the executive session. There was no matters, no concerns. And one of their representatives had attended a council meeting here to see how the council worked. I don't know if I wasn't here at that meeting, but attended that, and they were extremely complimentary of the council as well. The audited financial statements were, and a report thereon was delivered to the state auditor, or was transmitted to the state auditor on the 21st, last Wednesday, which was our deadline date there. And then after the state auditor approves that, those financial statements will be issued to the public. So if anybody has any questions of me, I'll be more than happy to try to answer them.
Scott.
I don't know if I have a question, but I think what's impressive to me, the last page of the, what I would call this audit report, they state the following, that the tone at the top and attitude for management staff was one of helpfulness, candor, and openness in response to audit requests and discussion points. That's a culture that's been created within this organization, primarily being driven by Brent, since he's at the top of that part of the organization. Kudos to you guys for a great job.
Kudos, Scott. Scott is, you know, I was an auditor for, out there doing this for 39 years. And if there was one thing in any company or any organization that I went into, it was that I consider to be a key component. That it's the tone at the top. It's the tone Steve sets. It's the tone that the accounting organization set. It's the tone that Vince sets. It's the tone that management team sets there. And I don't know how many years I've been involved here, 6 or 7 years, but been doing this for a while. And you know, it wasn't when Steve first came. I mean, we had to change the tone there. And I think that management has done a terrific job in doing that. So I think your comment is well thought out.
And I'd just like to reiterate what our chairman said, and thank you for your time
Yep.
and your due diligence and contribution.
So any other questions or whatnot?
Thank you so much.
Okay.
I have nothing.
Okay.
Brent's a Highland Hornet, this is what you'd expect.
There's actually a lot that goes on over the surface. To get where we are. Okay, closing matters, no old or new business. I assume we have no public comment there. Next meeting is in January, and is that the date? We don't have a session? What's the?
Next meeting is on January 22nd, the investment committee on January 10th.
Yeah, how do we work around the crowds? We're not. The legislature will be in session at that time.
So make it work hopefully better than we did today.
This is unique, we've never had this before, so you're entitled once.
Uber's still in our portfolio, so you could park elsewhere. Uber.
The lot's always open at 6 a.m. too.
All right.
Yeah, that's right. I'd like to move with adjourn, but prior to that, I wish everyone happy holidays.
Thank you very much.
Everyone happy, safe, sane
All right.
holidays.
We're official.
Here we go.